Good morning. I'm Guido Bicocchi, Director of Investment at McInroy Wood, and I'd like to thank you for joining this investment webinar. Before we begin, a few housekeeping items. You will be kept on mute for the duration of the meeting to aim to improve the sound quality. Many of you have already submitted questions prior to the event, but I encourage you to feel free to do so during the webinar by clicking on the question and answer button at the bottom of your screen. We'll do our best to get to them if they aren't already covered elsewhere. If we don't have time to answer your question during the live session, we will respond to you directly after the meeting. I'd like to assure you that all questions are anonymous, and while you can see and interact with us, no participants can see or hear each other. The content of this webinar is McInroy Wood's opinion and is not intended as a recommendation or promotion to buy or sell a particular stock. Hugo Swan, one of our investment directors, will take you through a short presentation covering the history and characteristics of asset price bubbles. Liz Wild, one of our investment managers, will then discuss our approach to investment in the current climate. After about 20 minutes, we'll then move on to our question and answer session, which will be chaired by Jane Calder, a member of our investment team, during which time we will try and answer the most common questions posed by you. We'll aim to finish the session promptly at 11:45. The world has changed significantly over the last decade, with innovation and growth in areas including healthcare, robotics, and electric vehicles. Asset prices in general have risen, boosted by cheap money from central banks. But many investors appear to have abandoned the normal disciplines of fundamental analysis and price criteria, and are assuming the current conditions will last forever. As a result, the values of some assets appear excessive. This is not a new phenomenon. There have been similar examples throughout history. Today's webinar will look at the lessons to be learned from history and our investment approach in the current environment. Hugo, over to you.
Thanks, Guido. Good morning, everyone. I'd like to start our discussion with some historical context. And this chart goes back to the early 1970s and shows 5 distinct bubbles up until 2008. There have been plenty of other bubbles during this period, and of course, many before this as well. As investors, we naturally focus on those bubbles related to what we see as mainstream investments, but there are plenty of other weird and wonderful examples out there. For example, in the late 1990s, there was a massive mania around beanie toys. I'm sure we've all heard of the tulip mania in the 1640s in Amsterdam. The chart lays bare the huge run-up in values that can happen as a bubble grows, and then the precipitous fall off in values as it bursts. I think that 2 points to take away from this are firstly, that bubbles are not uncommon, and secondly, that they can last for quite long periods of time. If we take the Japanese equity bubble or the US housing market bubble, both lasted for many years. Together, these lead to a question. Are bubbles something to embrace as an opportunity to make money, or something to fear because of the potential for huge losses? And as with so many things in investing, we believe the answer is a bit of both. It's also worth reflecting that bubbles are by and large confined to a small subset of assets at any one time, and that while these bubbles are rising and falling, there are other assets that may be less affected and may offer a less bumpy ride for investors. We feel that this offers some hope, and we'll explore later in the presentation the way that we try to navigate this for our clients. I haven't mentioned the current potential bubbles that I show on this chart. Those in e-commerce equities, the FANG stocks, and of course, Bitcoin. The advantage that we have with the earlier episodes in this chart is that we can clearly see the bubbles bursting, and we don't have that advantage with the latter 3. So rather than conclude either way at this stage on whether those assets are in a bubble today, we think it's worth spending some time examining the common factors in historic bubbles and seeing whether any of those apply today. Charles Kindenberger split bubbles into 4 separate phases, with this named mania phase being, to our mind, the most important to identify. Before this phase, we have a fairly standard investment market with what might be seen as a normal level of volatility in prices. However, at some stage, an event occurs which allows the formation of our bubble. And this could be a number of things. For instance, a new technology, a shortage of a particular commodity, or a change in legislation. Historical examples include things like the development of canals in the UK, which led to an investment mania in the 1790s, or World War I, preventing wealthy Americans traveling abroad for their summer holidays, and so creating the conditions for the 1920s Florida land boom and bust. Or more recently, the arrival of the internet in the 1990s, which led to the dot-com bubble that many of us may remember. The point being that there may be very real business cases that lead to rational investment opportunities, at least initially. Bringing this forward to today, the fact that electric vehicles and e-commerce are here to stay doesn't alone prevent a bubble from forming in values of related companies. But while such a change may trigger an irrational investment opportunity, something else is required to form a bubble. This involves a widening appreciation of the trigger event and an increased momentum in the valuation of an asset. Adding fuel to the fire are a number of conditions that appear to be common to many of the bubbles we've seen before, and certainly some of these are present today. I'll briefly talk through 3. Firstly, bubbles typically see high levels of first-time investors. Joe Kennedy, JFK's father, who made a lot of money in the 1920s boom in the US stock market, afterwards wrote of one of the signs that prompted him to sell out before the crash in 1929. He found he was receiving stock tips from the shoeshine boy that he visited every morning on his way into his office. He felt that if the stock market investing was as mainstream as that, then the values being achieved were not likely to be sustainable. Today, we can see the impact that a lack of live sports betting in the US and the boredom of sitting at home has led to a massive increase in first-time investors, particularly in the US market. Easy to access apps, which have been designed to gamify investing, have certainly helped too. The second common feature is debt-fueled investing. A parliamentary report into the UK railway mania in the 1840s found that 2 brothers who had subscribed for around £4.8 million worth of stock in today's terms were living off an annual income that's equivalent to around £7,000. Presumably, they were borrowing to pay for the investment and assuming that they could repay the debt by selling on the stock quickly to someone else at fairly short order. In a way, this is unsurprising, if making such transactions seem a surefire way to riches and require minimum upfront capital. And today, we can see parallels through the lending offered in apps and broking accounts, or particularly through the use of some financial products. Being able to buy a triple leveraged ETF on the FANG stocks may not be everyone's cup of tea, but it and a plethora of other such bets are very easily available for investors to increase their exposure to the stock market, while minimizing the upfront capital required. Lastly, a common feature that we see is FOMO, the fear of missing out. And here, greed rules emotion and becomes the driving force for investors. Even the most brilliant minds can be susceptible to this. In the spring of 1720, Sir Isaac Newton, who was not only a brilliant scientist, but also a very experienced investor, sold his shares in the South Sea Company, having made a pretty tidy profit on what was a long-held investment. However, over the summer, the stock price rose faster and faster, and Sir Isaac found himself buying back into the shares repeatedly, only to find that it hit the peak and rung the bell at the top of the market, which then collapsed. By his own admission, he lost a huge amount of money. And it's very easy today to see the parallels with Reddit boards and YouTube channels for day traders pumping up individual stocks, and also some of the hype that we see around cryptocurrencies. Now, the idea of this presentation isn't to fill ourselves with dread at the prospect of stock market returns, but perhaps to be a bit more realistic about whether some of the areas of the market that we see today are likely to be in a bubble at the moment. And certainly to us, it appears that some of them are. However, bubbles can last for some time, and they're not uncommon. So we feel we should be able to find a way to navigate our way through them successfully for our clients. We believe there are ways of doing this, and I'll hand over to Liz to run through our approach.
Thanks, Hugo. So this is another of our talented colleague David Shaw Stewart's cartoons, his take on the classic hare and the tortoise. And it quite neatly illustrates how we approach navigating these sorts of markets. So as Hugo said, bubbles aren't new, and we've written about them over the years, the tech bubble and others. And what's important to us is when it comes to our decision-making about both asset allocation and also the stock selection for clients' portfolios. So we do factor in the potential risks of these bubbles, even if we aren't directly involved in one of these asset classes that appears to be becoming overvalued. There are quite often unintended consequences if one of these bubbles does burst. So the challenge is to distinguish between the overinflated assets and what may be the underlying trend that is causing the attraction and they're reflecting. So then we focus on whether our clients would benefit from having exposure to that trend and how best to get that exposure without taking undue risk. That's the magic formula. So as we navigate this climate and others, there are two factors that we always keep in mind: the fundamentals and the bigger picture. So the stock market always heralds the future, but one of the symptoms of a potential bubble, as Hugo's mentioned, is when the market value appears to have diverged significantly from the fundamentals. So fundamental financial analysis is central to our approach, won't surprise you, but ultimately it is the sales, the profits, and these other financial metrics that underpin the market value of a company. And it's very easy to get caught up in the story of an exciting new product or a theme, such as the electric vehicles or that broader electrification transition, and lose sight of the financials. So we've chosen electric vehicles as an example here. Some of you might be thinking about buying one. You might own a Tesla, or you might even own shares in Tesla. And it's a great business. It's a really innovative business, and it's disrupted the traditional automotive manufacturers who are perhaps lagging in terms of innovation around hybrids and electric vehicles. And we need businesses like Tesla. We need innovation, particularly if we're going to deal with the challenge of climate change. However, it's an incredibly competitive industry. And Herbert Diess at Volkswagen has made very clear his intention that Volkswagen will catch up and become a leader in EVs. So if you look at these very simple charts, you can see how the market value of Tesla and its expected income are just so different to those of the incumbents and are dwarfed really by them. And this is, where you have to go back to the fundamentals and remember that these are the elements that support the market valuations. And without them, the smallest disappointment can lead to a dramatic fall in the value of that company. So the bigger picture, well, the bigger picture is just as important as the fundamentals when navigating these bubbles. We don't follow any benchmarks, so we are free to select sectors and regions that we believe will best deliver our clients' investment objectives. So we prefer to step back and consider all the different ways in which you might gain exposure to a theme such as electric vehicles. And these are just a few companies that are in our clients' portfolios, and they're all beneficiaries trend towards electrification of transport. Chroma creates testing equipment for electric vehicle chargers, batteries, amongst a whole host of things. Schneider is involved in manufacturing components for EVs, as well as that broader infrastructure, which is so crucial to the network. And Soitec is a specialist manufacturer of silicon for microchips, which are in great demand because of their high performance properties. What's common about all of these companies is they're profitable, they're innovative, and they're well managed. They're also growing at a decent rate, but their share prices are far more attractive than some of these headline companies that you might read about in the newspapers. So another element of this is our discipline, so that even if the share price of one of these companies was to get ahead and perhaps look expensive, we would review this and actively manage the position, potentially taking profits and reinvesting that money into one of our other preferred companies that would offer better value. This ensures that clients' portfolios remain well diversified and balanced, capturing the upside of some of these interesting growth trends, but without taking undue risk or overly exposing clients to potentially unsustainable share price movements. So one final thought I'll leave you with is another type of bubble that we try very hard to avoid, and that's the bubble of our own conversations within the team. We all come from quite different backgrounds, but we all read very widely. So it's not just company news and analysis that we read, it's scientific journals, tech blogs, and we're also fortunate to have contacts in a whole host of sectors. And this fosters and nurtures a really diverse pool of thought and knowledge and opinions. But we also really value the conversations that we have with you as they bring their own unique perspective. And we look forward to having more of these conversations with you in person as the restrictions here in the UK lift. So that concludes the formal element of this webinar, and I'll hand over to Jane now for Q&A.
Thanks, Liz, and good morning to everyone. Please do send in any questions that you may have. Hugo, I'd like to ask you the first question. If lots of stocks are too expensive right now, where is the value and what opportunities are you looking at?
Thanks, Jane. Certainly, I think some areas of the stock market, as we've discussed, are expensive, but by no means all. There are certainly some areas which are really not expensive at all. A lot of those relate to what might be termed as old economy stocks. And for some, there's good reason why they're not expensive. The growth in those areas may be slower in the long term. But even those areas may well benefit from the opening up of economies, the reacceleration of growth around the world. And they may rise from having been relatively lowly rated to having a more realistic or a better valuation, certainly compared to the big disparity there is at the moment with the more growthy or bubbly areas of the stock market. I think we have an advantage in the way that we approach investing, which is that we, as Liz has mentioned, we don't follow benchmarks. We don't feel the necessity to tie our portfolios to an index. And so we're really able to venture off-piste into less well-covered names. And those less well-covered names of all kinds of sectors are often better value, either because they're less understood or because they simply haven't been followed in quite as much detail as the very big, well-known companies. And there we think we're also able to find interesting companies. So, There are opportunities around sectors that have been out of favor, but will come back into favor because of economic growth. And there are also opportunities in some of the smaller, less well-known names that have not been puffed up quite as much in terms of valuation as some of the better known companies.
Thank you, Hugo. Liz, the next question we have is on ESG. ESG themed investing is becoming increasingly popular. Is there a risk of this trend becoming overheated?
Okay. So ESG refers to environmental, social and governance matters. And really, it's just the latest term for the very broad range of ethical considerations that many investors, such as ourselves, have always considered when we're looking at companies. What's really, I think, behind part of this increased interest is concern about the climate. So it's the E element of ESG that's particularly attracting attention, because there's a huge amount of investment going to be required into this area. So is it overinflated? I think you need to distinguish between products that have been labeled as ESG connected in some way, and underlying companies that are actually delivering innovative products such as air source heat pumps or solar panels or more efficient energy systems. And I think that there has been a shift because of this concern about the environment that has meant that investors have sought out alternatives to what they believe are traditional assets. I don't think it's a bad thing as such, but I do think you need to be careful about what you're investing in. And what we have seen at the company level is certainly that some of these individual companies, there's a Swedish business called NIB who make air source heat pumps. Their share price has attracted what we regard as an ESG premium. So for investors like us, that just means we do our homework and we're patient, and we wait for a more attractive opportunity to fold that into clients' portfolios.
I could add, I think the way that we approach investment management, because we invest directly around the world, that means that we can speak to all of the management teams and of all the companies that we do invest in and build the relationships with them to understand their approach to ESG issues, whether that's reducing the amount of plastic perhaps that they're using, whether that's reducing their carbon footprint or their board structure, and whether they've got equal opportunities for promoting female board members, for example. So I think that's an important part of how we approach ESG as a firm.
Thank you. Hugo, electric vehicles were mentioned in the presentation. Why do you continue to hold fossil fuel exposure in your portfolio?
Thanks, Jen. We feel that fossil fuels are a key part of the transition towards a lower carbon future. It's very clear that coal is still required for making steel, and I'm sure we're all aware that there's a lot of steel goes into making a wind turbine or, for example, a solar field. So we don't own any coal stocks, but I think that illustrates the point that simply excluding a sector is quite difficult, quite a blunt tool. Another illustration of this is if you think about the level of oil production that comes out of the big international oil companies that we can invest in, such as Shell or Total, that's a very small share, really, of total oil production. So if you simply blanket that as an investment sector, what that may do is push oil production away from the listed companies into more of the state-owned companies. And there's much lower chance to influence the way that these companies behave. Certainly, we do think that the transition to lower carbon future is important. And the way that we invest in the oil companies is through Shell and Total. Those are the main exposures. The reasons we pick those are that we think they're in a better part of the path towards transforming their businesses away from being very oil dominated towards being broader energy companies. And we think that's the right approach. But certainly it's something that remains contentious, and we're keen to remain very engaged with the companies we're invested with.
Thank you, Hugo. Guido, a question's been sent in regarding private equity. Is there a bubble in private equity? Many people appear interested in this asset class as an alternative to stock markets.
Thanks, Jane. Well, private equity as an investment has been around for many years. However, over the last 10, 15 years or so, certainly investment in private companies has become more popular. I think there's probably a couple of reasons for that. One is there's actually been a reduction in the number of listed companies in markets as companies have merged together to take advantage of things like globalization. And also there's been a lot of success. So we all know about some of the large technology businesses, particularly in America, which stayed private for much longer before they then eventually listed on the stock market. And as a result of that, people have made a lot of money, and that's attracted more money into the sector. And one of the things that happens when you get more money chasing the same number of companies is that the value of those companies gets pushed up. So absolutely, I do think that the value of private businesses has been elevated because there's been more money there to undertake transactions. And the consequence of that, I would suggest, is that future returns in private equity may well be lower because of the greater appetite to invest in them.
Okay, thanks, Guido. Hugo, the next question is about the UK commercial property market. With more employers talking about allowing employees to work from home post-pandemic, surely the commercial property market is very overvalued right now. Do you think that caused a banking crisis like in 2007, 2008?
Okay, thank you, Jane. There are a couple of legs to that question, I think. So within the UK, we do have some commercial property exposure through Segro, which is predominant in warehousing, and also Assura, which provides GP surgeries and primary healthcare facilities. So both quite specialist areas. And obviously there are other areas within commercial property. So it's a broad sector. I think that the bigger risks are really highlighted in the question. So the bigger risks are probably around offices and potentially shopping malls. There is likely to be a change in working patterns, and we have seen a shift in shopping patterns with fewer people going into physical shops. But both are still likely to be a pretty big feature in life when we get back to whatever the new normal is. And also, I think that there is a lot of the managers of these kind of property companies have historically shown quite a lot of flexibility and the ability to repurpose existing buildings and to convert, for example, to housing, where in many parts of the country there still is a shortage. I mean, certainly it is a challenge sector. I think that our approach to that sector has been to be quite selective, and that's why we have the UK exposures I've mentioned. In terms of a banking crisis, I think that a lot has changed within the banking sector since 2007, 2008. I mean, the most obvious thing is the amount of equity that these banks are now required to hold. That's been increased very, very significantly. And that, I think, creates a bigger buffer to prevent a crisis. The other thing to reflect on is that what really drove, or a big driver of the banking crisis in 2007, 2008, was less around losses on property and more around the funding of that property exposure, with a lot of it being very short-term debt. And I think, again, there's been a huge change in banking regulation to reduce banks' ability to fund long-term assets with short-term debt. So we don't invest in the banking sector for a number of other reasons, but I don't expect a crash in commercial property to lead to a banking crisis.
Thanks, Hugo. Liz, the next question is for you. Why don't you have more exposure to technology stocks? And aren't you worried about underperforming the S&P 500?
Okay, so technology stocks. So we don't hold the big technology companies that you might be familiar with, Google, Alibaba, Facebook, something like that. And that's quite deliberate, but we do have quite a lot of technology within our portfolios, as I illustrated in the presentation. Our preference is to look at those big themes and then find how best to fold those into client portfolios without taking too much risks. So we have the benefit of the upside with less perhaps on the downside. So no big tech, yes, but we have a lot of tech, and it's either software, it's hardware, but it's also businesses that may not seem to be a technology company at the top level, but actually have a lot of innovation and technology within them and their products. So does that worry us as to whether we might underperform? Was that the question, Jane? Yes. Yeah, okay. So most of our clients have a very similar objective, which is to preserve and grow their capital ahead of inflation. So when it comes to benchmarks, we don't follow any, but the one that we're most concerned about is inflation. And our track record, which is very public and goes back more than 30 years, shows how we have delivered on what our clients are looking for. And really, that's what we're more concerned about than any one particular market or asset.
Thanks, Liz. Guido, a question that's come in for you. Do all bubbles burst?
Eventually, everything must go down because, as I said in my introduction, the definition of a bubble is when investors expect the conditions to carry on forever, and that can't happen. Whether it's because the fundamentals of individual businesses change. So, for example, if we look at the FANG stocks, we've started to see a lot of regulation being imposed by governments on how those businesses operate. They're effectively monopolies in their own industries. So things like that will start to influence the ability of those businesses to continue to grow at the rates that investors are expecting them to grow at in order to justify the valuations that are being ascribed to them. So I think eventually something will always burst the bubble. It's very difficult often to understand what or foresee what the event will be that will burst it. But it's normally something simple, and ultimately it's a change in investors' attitudes or investors' expectations for what the future of that particular asset holds. Hugo, I don't know if you've got anything you'd like to add to that.
I think I would. I think an important part of the answer to this is that not everything is in a bubble, and I think that we see our job as trying to avoid those areas that are getting into a bubble. And therefore to avoid the bursting, as Guido has said, it's very difficult to predict when a bubble would burst. So we are very prepared, and we have over the last 30 years always tried to be slightly early in terms of reducing allocations to equities where we think valuations are getting too high. And that may lead to a period where the stock market is roaring away, and we may have a relatively less exciting return because we may have 30 or 40% of a portfolio in bonds rather than having an 80% equity allocation. But we're happy to take that approach because we think that by being patient and by thinking about the long-term returns, you're better off to avoid the last little frothy bit of a market upturn because it allows you to avoid the ensuing crash and then to come back into the market when valuations are more realistic.
Thanks, Hugo. Guido, I'd like to ask you a question about our approach to investing. Does your traditional approach with equities, bonds, and gold really protect portfolios from the potential downside of these bubbles bursting?
I would answer that in a couple of ways. So the first thing is to say it depends which bubble is bursting. So if we take Bitcoin, for example, and the rise in the value of Bitcoin, if that was to collapse tomorrow, then actually it would have a limited effect on our portfolios because we don't have any direct exposure to Bitcoin, and its performance is unlikely to influence wider stock markets in general. However, looking at the FANG stocks, which account for more than a quarter of the US stock market now, if they were to fall back in value significantly, then that would have wider implications for global stock markets. And because we're investing in shares, our portfolios would not be immune from that. So as various of us have said, what our approach to that is therefore to be selective. And the companies that we look to include in our portfolios are very much long-term investments, and They should have strong balance sheets, have good competitive positions, and therefore be able to survive and come through a recession or a stock market fall in a better position or in a better way than perhaps some of the more volatile stocks, the ones that have been, their values have been increased. So our approach to equities is to try and to protect our clients and portfolios from the worst of the falls. In addition to that, where we hold bonds and gold in our portfolios, they also act as insurance in those portfolios. So when we look back to what happened this time last year with the coronavirus, investors were looking to sell their shares and looking for safe havens for their investments. And those safe havens were things like US treasuries, so the US government bonds, and gold. So whilst the value of the equities in our balanced fund and our income fund were falling, the value of our bonds and our gold were rising, and that was helping to protect the portfolio as a whole from the worst of the stock market falls. And I still think that there is merit in holding the bonds and the gold for that reason within our portfolios.
Thanks, Guido. And then just following on from that, what are your views on the outlook for government debt, and what are your views on inflation?
Goodness. So the outlook for government debt and inflation, I guess, is linked because interest rates are very much, they follow the expectations for inflation. As many of you will know, that as interest rates go up, the value of bonds tends to fall. So if we take inflation first, we've been thinking for a long time, and particularly over the last year or so, since the government and the central banks came in to do what was absolutely necessary in terms of supporting economies by cutting interest rates and by introducing furlough schemes and support for individuals and businesses. There's a consequence to that stimulus. And that consequence is if that stimulus carries on for too long. So we're starting to see a recovery in the economy as people, hopefully we're starting to see lockdown restrictions ease and people coming out and spending a bit more. If that stimulus carries on for too long, then effectively they could end up overstimulating the economy and pushing up inflation. So we're concerned about the prospect for inflation in portfolios, and that then means central banks are likely to react to that inflation by raising interest rates, which, as I've said, is not good news for bond values. So what we've done in our portfolios is, one, to keep the bonds short duration, so they mature within the next 3 to 4 years on average, and that means that they're less susceptible to moves in interest rates. The other thing we've done is include an allocation to inflation protected bonds. Those are bonds whose value and the interest rates rise as inflation rises. So the portfolios will get the benefit if there is, or have some protection if there is a rise in inflation.
Thanks, Guido. Hugo, a question that's come in. Are rising commodity prices, for example, copper, a concern for the industrial companies like Schneider Electric in which you invest?
Thanks, Jane. Yes, I think we've seen quite a big pickup in copper prices and some other commodity prices, and given the shift to electrification, it's reasonable to think that the copper market will be supported for some time. From Schneider's particular perspective, I think that we feel it's got a number of defenses against the commodity prices rising that should mean the impact is manageable. Firstly, copper is used by all their competitors in a similar way. Therefore, it's not specific to Schneider. It would affect all of their competitors, and that will help the industry pass costs through. I think another aspect that helps Schneider is they're often selling to electricians in a large part of their business, selling to electricians who are then fitting on behalf of a customer. And as the electrician is making the decision around the purchase, they're less price sensitive typically. So they're not paying for it. They don't mind seeing prices rise a bit. They are able to pass, the electricians are able to pass that cost on to the end customer. And also, and a third element is that often where it may be price pressure, that component is a relatively small part of a wider project. So if you think about a building refurbishment project to try and drive savings in electricity, which is an important part of Schneider's business, the electrical components are certainly part of that, but there'll be many other factors going into the refurb, and the fact that copper prices are going up and making some of those elements less expensive, typically because it's a smaller part of an overall mix, the price sensitivity is relatively low. But it is a risk. We think that Schneider's pretty well placed to deal with it. And that's always a part of our consideration when we look at companies. Is their competitive position, is their ability to defend those profit margins and make sure that those margins are sustainable given changing conditions of input prices.
I might just add to that when commodity prices are fluctuating, it actually sometimes opens up opportunities for newer materials, which are perhaps trying to gain a bit of traction and adoption. So there's a business that some of our clients have, which is called Victrex, which makes a very high performance polymer. And this can quite often be substituted for metals. And when you're seeing high metal prices in particular, it suddenly makes the dynamics of that alternative material far more attractive. Victrex products can also take out the weight and some of the electrical interference in some products. So there's a number of reasons why attractions to that sort of alternative product can come to the fore.
Great, thanks Liz. I'd like to stay with you. Could you hold Bitcoin in your portfolios as an alternative or alongside the gold you already have? And if so, would you envisage McInroy Wood investing in Bitcoin at some point in the future?
Okay, so the short answer is, if we wanted to invest in Bitcoin, there are lots of different ways of doing it. You don't have to have some super computer tucked away in our office somewhere. So yes, we could invest in it if we wanted to, but far more important is, would we want to? We've had quite a lot of discussions internally about cryptocurrencies. Bitcoin is just one of those, and also about the technology behind it, blockchain, which is very interesting and could have applications across a whole host of other industries. But if you're thinking about it in the context of gold, I think it's quite difficult to compare the two from our mindset anyway. Gold, as Guido's mentioned with the government bonds, is in there as part of our insurance policy, our ballast, if you will, to try and protect clients if there was an economic weakness or a stock market fall. And the dynamics that we've seen with Bitcoin, it featured on Hugo's chart, with a near vertical line, if you will, it doesn't suggest that it would provide that safe haven characteristic that we would be looking for. So at this stage, it's not going to be going into clients' portfolios anytime soon, but it's an interesting area. We talk about it along with other things such as digital payments and fintech. They're in our eyesight, but not one for us right now.
Thanks, Liz. Guido, I'd like to ask you a question that's come in. Most of your companies are global. How do you, or would you, adjust your portfolio based on your long-term expectations of sterling?
Thanks, Jade. So in relation to the companies themselves, we very much spend a lot of time looking at where their sales are, where their operations, so their manufacturing or services are based, and understanding the dynamic, therefore, of how currency could affect their operations. However, having said that, as the question suggests, a lot of the businesses we invest in are global, and therefore they effectively hedge currency within their own businesses. So we don't look to double hedge or add to that within our portfolios. Where currency does have an influence on our views is twofold. One is on economies. So, for example, if we do think that sterling's going to be weak for the considerable future, then that might have an impact on the economy here. And things like if we're importing lots of goods, it might add to inflation here. If we've got businesses whose operations are primarily based in the UK but export a lot of their goods and services, then it will make those goods and services cheaper when they go abroad. So where there is an obvious difference, we will look at that and assess whether that's good news or bad news for that particular part of the portfolio and adjust it accordingly. The other area that we have to consider currency, particularly given interest rates at the moment, is in the bonds allocation in the portfolio. Yields are next to nothing on all government bonds, and in some cases we're now having to pay for the privilege of them lending to us. So changes in foreign exchange rates can make a big difference to the value of bonds in portfolios. However, having said that, we're not going to try and second guess what's going to happen to an exchange rate. And ultimately, as we've said before, the bonds are there at the moment to provide very much the insurance in the portfolio, the ballast, as Liz described. When stock markets equity values fall, we would expect the bonds to rise. And therefore, we're concentrating on currencies that are perhaps safe havens. So things like the US dollar, which has always been held out as a place to invest your money whenever you're concerned about the outlook for the world, because it's the currency that's used to trade around the world. And also sterling, because the vast majority of our investors are based in sterling itself. So currency does influence what we're our decisions and how we're allocating our portfolios, but it's not a significant consideration for us.
Thanks, Guido. Hugo, I've got a question that's come in. The breaking of bubbles can have quite long-term outcomes, the 2008-2009 crisis being a good example. What bigger consequences are there once the current bubbles burst?
Thanks, Jane. I think it depends which bubble bursts. I think Guido is quite right in saying that we think that if the Bitcoin bubble crashed, it would have limited effect on our portfolios, and I think limited effect on most things around the world. Bitcoin is held relatively narrowly, and I think its ramifications of a bursting of that bubble would be pretty limited. I think the bursting of a bubble in perhaps the FANG stocks maybe have more of an impact, particularly because of the levels of passive holdings of these stocks, and that would, what would require the impact to be big would be if the bursting of the bubble leads to many retail investors or many investors withdrawing money from passive funds, which would then force the passive funds to sell their holdings of the biggest weighted stocks, and potentially that could create a pretty negative feedback loop in the markets. So I think that would be probably in the short term the biggest effect. I think I do see a difference between the breaking of these sort of bubbles and the breaking of a big real estate bubble, where the banks have got huge exposure through lending and have got very big problems with managing their exposures, because the banks and their ability to lend are very important for keeping the economy going. And what we saw certainly at the end of the collapse of the Japanese equity and real estate bubbles, and I think also in Europe and in the US following the 07-08 crash, was the banks acting in a way that really put the brakes on economic growth. They shrunk their balance sheets. They didn't lend and facilitate startup and new business growth. And one of the reasons that the US economy kick-started more quickly than perhaps in Europe was that their banks had a shorter, sharper clean out of bad loans, and then were willing and able to start lending again more quickly. I don't think that those parallels work today. I think that they are different. That's not to say that the bursting of a bubble wouldn't have an effect on stock markets. It just probably is limited to that.
Great, thanks, Hugo. And then Guido, just a final question for you. Why would someone invest now? Shouldn't our clients wait until the markets fall back? And what is your outlook for markets?
Okay, thank you, Jane. I would suggest that now is a good time for investors, particularly those with a medium to long-term investment horizon. By that, we 3 to 5 years plus, to invest. The events of the last 12 months have been traumatic, but it's forced a lot of change and accelerated a lot of that were all relevant in areas such as telecommunications, environmental, healthcare, etc. And those changes and those trends offer long-term opportunities for investment. So I definitely think that now is a good time to be investing. The other thing I would say is, because we actively manage the allocation between our bonds, our gold, our cash and our equities, and also where we're investing in the world, when we're cautious, we will adjust the portfolio to reflect that caution. And when we're feeling more bullish about the world, we'll adjust our portfolios to reflect that. Which leads me on to what's our view at the moment. And I would describe that as cautious optimism. We are coming out of the other end of this coronavirus. We've got vaccines which are working and are being rolled out around the world. And that provides hope and optimism, because we will see the ending of, or the removal of these lockdown restrictions. People will go back out into the world, and those of us who have been fortunate enough to save money, I'm sure will be desperate to get out there for a holiday or to go out for dinner or whatever it is. And that will help to then stimulate the economy and drive it forward. The other thing we're hopeful for is productivity improvements. A lot of us, and McInroy Wood included, have had to adapt the way we work over the last year or so and use things like video technology. And that has made us more efficient in many ways. So we will carry on doing that. And for those businesses who've not been able to adapt, they will go back to doing things the way they used to. So that should overall provide a productivity benefit to economies. So we're very optimistic because of that. We think the economic outlook from here is improving. Having said all of that, we've been talking about bubbles and the increase in asset values. Investment markets anticipate a lot of that good news. So we've got to ask ourselves what in the short term would help them to rise further. And that's where the caution comes in. And as I've described before, we're looking at and monitoring the stimulus that's being provided by governments and central banks. Is certainly still needed in this current environment, but we feel that they may well err on the side of caution and continue to stimulate beyond when economies can effectively support themselves. And as I've said, there's a risk there with inflation. The other thing that we need to keep an eye on is the amount of debt in the world. Governments have borrowed record amounts of money over the last year in order to fund these stimulus measures, and ultimately that debt has to be repaid. So it comes back to monitoring the fundamentals and having one eye on the long term and these trends that we think we can take advantage for our portfolios and for our investors, but at the same time being cautious enough that we recognise that asset values are elevated, and it's monitoring the relative benefits and advantages and disadvantages of the different types of investments we're investing in, and adjusting the portfolios accordingly.
Thanks very much. Thanks, Guido, Hugo and Liz, and also thanks to everyone who's sent in their questions. Guido, I'd like to hand back to you now to sum up the webinar.
Thank you, Jane. As we've been saying, asset prices in general are high, and some appear excessive. However, there are long-term investment opportunities, and we must remain disciplined, calm, and continuously assess the risks associated with those opportunities. Reviewing the relative merits of different assets, countries, industries, and companies, we're confident that this investment approach will continue to work and meet the needs of your clients. If you haven't had a question answered, then we'll come back to you directly. Please also let us know if you have any feedback about this webinar by emailing Jane, including any ideas you might have for future events. In the meantime, thank you for participating in this session, and I hope I or one of my colleagues can look forward to seeing you face to face in the not too distant future. Until then, we wish the very best to you and your families. Thank you.